PPM Due Diligence and Term Sheet, presented by Sheet-Sellier. A private placement offering is a way of raising capital that involves an offering of securities to an individual or small group of investors. The offering is made by the company and is usually more cost-effective than a public offering. Cost savings are seen with the elimination of brokers or underwriters. Costs are also cut in the long term because of the elimination of registration and reporting requirements for the ongoing transactions. Because it is private, the company avoids registering with the SEC and reporting requirements involved. Another advantage is the confidentiality of the transaction. Because it is private, the company has control over the complexity and scope of the offering. These transactions usually involve a small number of participants. The participants are the company making the offering and a select few investors. This is also an advantage in itself. Private placement allows the company to select the investors it wants to work with. This increases the probability that the goals and values of the company and its investors align. Most investors in these situations have been in successful businesses and may have even been entrepreneurs. They have the ability to provide valuable guidance and advice. A private placement memorandum is a document used in a private placement offering. It explains the securities that are included in the new offering for private placement. Because they do not have to register with the SEC, this document must explain the reasons why it complies with Regulation D. This is a regulation that exempts companies from registration, and it is discussed further later in this presentation. A PPM is complex, and it is beneficial to consult with someone who specializes in their creation. The options for specialists usually are attorneys, investment banks, or private placement memorandum specialists. The simple and usually less expensive choice is the attorney. New firms will hire an attorney to prepare the document, and the company will take over when it comes to presenting it to potential investors. The document itself is similar to a prospectus and details the shares in the private company. It is similar to the documents received by investors in public companies like stocks or mutual funds. There is usually a summary of what is being offered and financial data, as well as more general information like a description of the industry the company operates in. It specifically details all the terms of the investment, requirements of the investor, and proper disclaimers and disclosures related to the business and the entity. It is also similar to a business plan because it contains a lot of the same information but is more directed toward the details of the investment and what is being offered. Sometimes the business plan is even included in the PPM. They both contain current and pro forma financial statements, details on management and industry operations. The business plan is more strategy driven, while the PPM is making an offer to the investors. The term sheet is a section of the PPM, and it discusses specifics of the investment. It forms the basis for high-level terms and conditions of the deal. The investors present it to the firm seeking funding before the actual funding agreement is made. In addition to outlining the proposed terms, the term sheet also states the value of the transaction. Valuation is the main focus of both the firm and the investors, and more time is usually spent on this aspect over most other aspects. Another thing that is important about the term sheet is an exit strategy. The longevity of the investment is usually outlined, and this is important because they have to agree on how long the investors will be involved in the deal. Due diligence is the process of investigating and evaluating business opportunities. People in business have a duty to act ethically in business transactions. There are multiple areas of due diligence, and the process may vary depending on the purpose for which it is being performed. Some purposes include potential mergers or acquisitions, material transactions that may occur in the future, questions regarding the process of the transaction, investigation of policies and practices, or new investments in business ventures. In private placement, the due diligence checklists are usually used, and they usually involve some key important steps, including an investigation into how the funds are going to be used, as well as an examination of expenses, profit margins, revenue recognition, and financial and strategic goals. Some of the related regulations for private placement are Regulation D and SCORE. Even though private placement does not require registration with the SEC, there are still a number of regulations that must be followed in the process. Under Regulation D, private placement memorandums require a limited offer and sale of a company's stock or securities without registration. There are still risks involved, but it is easier to comply under Regulation D. It also gives the company insurance with disclosure. There are rules that must be followed in order to comply, and most of them limit the number of investors and vary based on the amount of the investment. Some of these rules are 504, 505, and 506. In addition to Regulation D, there are also state laws regarding securities. Recently, states have begun using SCORE, which is the Small Corporate Offering Registration, and it has simplified and streamlined the process of complying under Regulation D.